Silver got smacked down on the screen today, but nothing that matters for the next 6-12 months actually broke. Only leverage and weak hands did. Silver investors, everyone woke up expecting a straight line to $100 because war broke out in the Middle East. And instead we got a $6 crash on the open. Silver ripped to $97 overnight, then by US morning it was trading around $87.90, down almost 7%. Gold? Gold was basically flat to green on the day. So what in the world is going on? War in Iran. Silver down hard. Gold holding up. China paying way over COMEX prices for both. This is not random. This is exactly what a highly leveraged, emotionally fragile market looks like when fundamentals and positioning collide. Let's break it all down. What happened to silver overnight and at the US Open? Why gold is up while silver is down? What China's doing with gold at 6.329 and silver at $110? How the gold-silver ratio just flashed a buy-silver signal again. And why these red candles are the exact spots I like to buy, not sell. This is not financial advice. This is my framework so you can build yours. Segment 1, the insane overnight move, $97, then $87. Let's start with the tape. As soon as markets opened after the war headlines, both gold and silver gapped up. Silver shot as high as about $97 an ounce. Gold pushed up toward $400. For a few minutes, it felt like the obvious trade was finally playing out. War, Shishir, safe haven rush. Metals moon. Shorts destroyed. Then the chart went crazy. On X, Silver Trade posted, massive volatility in silver trading. Never seen a chart like this. Silver gaps up to 97. Gaps down to 93. Gaps back up to 95. That's not normal intraday noise. That's air pockets. Price jumping between zones where there are no resting bids or offers. And then came the US Open. Just as the markets were opening in the US, silver was slammed down to below $90 an ounce. While I was filming, silver traded down to around $87.79, off $6.50, almost 7% on the day. Gold at that moment, pretty much flat. So in less than 24 hours, silver went from the high 80s, 97, low 90s, mid 80s. Gold went up, puked on the open, then basically stabilized and even firmed. That's your first clue. This is not about silver being wrong and gold being right. This is about volatility, positioning, and a stronger dollar smashing the most leveraged emotional asset on the board. Segment 2, stronger dollar, plus fear index, Gross-Stockshire weird behavior. Look at two big macro indicators today, US dollar index, DXY. The US dollar index is up for the day. The dollar is getting stronger. When the dollar goes up sharply, commodities priced in dollars often correct lower, even if the long-term story is bullish. Fear and greed index. The fear and greed gauge is in the fear category, and rightly so. There's a war going on in the Middle East, and it looks like the war is not going to be wrapping up anytime soon. So we have high fear, stronger dollar, war just escalated. In that environment, some investors run to cash and treasuries first, not straight to silver. Others panic liquidate anything volatile to reduce risk. Silver gets hit harder than gold because it's thinner and more emotional. That's why you can see gold holding up, even green on the day. Silver down 6 to 7%, screaming on your chart. Fear doesn't always express itself as buy everything shiny. Sometimes it expresses itself as dump whatever's most volatile, hide in the dollar, and figure it out later. That's exactly what we just watched. Segment 3, China's gold, 6,329s, and empty shelves. Now here's where things get interesting. While Western paper markets were playing ping pong, China was quietly moving into a different universe. On X, Air Sasha markets posted physical gold trading at 6,329 an ounce in China. Physical gold stores across China have stopped selling investment gold bars and are only selling craft gold bars at about 6,329 an ounce. Let's unpack that. 6,329 versus Western gold around $5,400, $5,450 when this was posted. That's about a $900 premium over the official gold price. Investment bars, the usual bullion investors buy, are simply not available. Only craft bars, jewelry-type decorative pieces are being sold at that elevated price. Nobody's quite sure where the exact line between investment and craft is in their classification. But one thing is clear, at 6,229, there's a massive premium over where gold is. And China's gold mining stocks all hit their daily limit up. Banks there are experiencing a buying rush on accumulated gold. It's not just a one-day panic either. China has about 336 trillion yuan in savings, trillions of dollars equivalent, sitting in the banking system. With war, inflation risk, and currency fear, even a small percentage of that moving into gold is explosive. So on the same morning, Western retail sees silver down $6 and freaks out. Chinese savers are bidding gold up to 6,129s and emptying shelves. Now let's check silver in the East. Segment 4, silver $110 in Shanghai, the East-West gap. Silver isn't just expensive in China, it's at triple-digit levels. Silver Dragon cites silver closed at a very high level, 110 an ounce, in Shanghai. These are US dollars we're talking about, so a massive premium between the East and the West for both gold and silver. Right now you have COMEX silver in the high 80s, low 90s. Shanghai silver settling around 110. That is a 20 plotters per ounce gap between a paper contract in New York. A physical linked price in Shanghai. Add in the gold side, China, $6,229 for physical craft bars, investment bars unavailable. West, around $5,400, $5,450 on screen. What's happening? It looks like both gold and silver are trying to go much, much higher. This is going to widen the gap between the East and the West, and ultimately a lot of metal is going to flow into China. That's the key. On the dips and crashes in Western paper markets, China is quietly buying and locking up physical. Over time, that flow doesn't come back. It's gone. So when you see red on your chart, someone else is seeing discount inventory. Segment 5, JP Morgan's $8,000 gold case and what it implies for silver. Now let's talk about the big dogs. Even JP Morgan, not exactly known for being gold bugs, is now openly talking about $8,000 gold. Here's their logic. Private investors currently hold about a 3% allocation to gold in their portfolios. If that allocation simply rose to 4.6%, their models say gold hits $8,000. That's not everyone going full gold maximalist. That's just a modest shift from 3% to 4.6%. Now compare that to what others say is reasonable. Morgan Stanley suggests a 20% gold allocation in some frameworks. Ray Dalio recommends 5-15%. Bank of America sees 30% as reasonable in certain scenarios. Silver Dragons is blunt. If allocations move even partially toward those levels, just imagine what will happen to the price of gold. I mean, 8,000 could be blown out of the water. We could be looking at 10, 15, maybe even 20K in the coming years. Now ask yourself, if gold does that, 8K, 10K, 15K, where does silver go? Bank of America just revamped their silver price target for 2026. Michael Widmer, the bank's head of metals research, says silver could reach anywhere between $135 and $239 per ounce before the end of the year. Yes, that's a comically wide range. But it tells you this. Serious banks are now comfortable modeling triple-digit silver in the near term. Today's $6 drop doesn't cancel that. It just discounts it for anyone willing to buy into fear. Segment 6, war plus missiles. We're silver demand, not less of it. There's another angle that isn't getting enough attention. War uses silver, not metaphorically, literally. Nostra House of Gold summed it up. I have bad news for the military-industrial complex. You need a lot of silver to replenish all the missiles. Well, there is a worldwide, multi-decade silver shortage. Every smart missile, guidance system, radar, drone, communication system is packed with silver. It's not optional. You need high conductivity, high reliability metal that works in extreme conditions. Silver is that metal. So when missiles and drones fly, stockpiles get depleted, governments ramp production of hardware, the demand for silver goes up, not down, and this is layered on top of a 6-year supply deficit. We are right now in the middle of a 6-year supply deficit, as Silver Dragons puts it. That means 6 straight years where demand has exceeded mine plus recycling supply. War doesn't give the silver market a break. It steps on the gas. Segment 7, gold-silver ratio, alert triggered again. Now for one of my favorite tools, the gold-silver ratio, that's gold price, silver price. It tells you how many ounces of silver it takes to buy 1 ounce of gold. When the ratio is high, silver is cheap relative to gold. Low, silver is expensive relative to gold. Today, as of filming, silver is around $87.79, down almost 7%. Gold is roughly flat. The ratio just moved above 60. Silver Dragons calls it, we do have a gold-silver ratio alert. At the moment, it is above 60. So this once again changes my strategy to include buying silver. That's the key behavioral shift. When the ratio jumps above 60, I tilt toward buying silver. When it's low, I tilt more toward gold. And check the pattern. During COVID, silver was around $18. Panic hit, silver flushed to $12. Then it ripped to about $30 in a very short period. Same structure, big macro shock, initial dump as people raise cash, then a violent rebound as the real safe haven and industrial demand kicks in. He says, if we do see a massive correction, that's probably what we will see, a very quick turnaround. History doesn't repeat exactly, but it rhymes loudly. Segment 8, why I buy red candles, not green ones. So what do you do with all this? Let me lay out the mindset that Silver Dragons is using, which is similar to mine. Expect volatility. Expect to see volatility in the metals like we saw last night, whether it's big moves up or big moves down. This is not a quiet environment. War, deficits, China premiums. It's supposed to be wild. Use red days as opportunities. When it's moving down, I would say that's the time to buy. That's when I like to buy. When I see the red, I go, okay, now's my chance to buy, because I can get it cheaper today than I could yesterday. So buy the dips. Take advantage of those when you can. Except that war doesn't guarantee up today. I know a lot of people were expecting both gold and silver to be up today pretty big because of the war in Iran, but that's just simply not the case. We've got silver down. Gold is pretty flat. Markets don't pay you for being right in theory. They punish you for being over-levered in the wrong time frame. Think in weeks and months, not hours. He openly says, silver could keep dropping, especially if we see a big crash in the stock market. It can dump out the gate, but usually it does recover pretty quickly. He thinks it's certainly possible we could see silver above $100 an ounce before the week is out, but admits he doesn't know. That's intellectual honesty. No one knows the exact path. We do know the structure. China pricing gold at $6,329, silver at $110, Western paper puking silver to the high 80s, war increasing silver usage, 6-year supply deficits, Wall Street banks modeling $8,000 gold and $135,000 to $39 silver. In that structure, red candles are discounts on a long-term bullish story. Green candles are what you get paid for, sizing right in advance. Segment 9. What this all means if you're watching this today. Here's where we stand, all in one place. War has started in the Middle East and looks like it's not going to wrap up anytime soon. Silver ripped to $97, then got smashed down to the high 80s. Gold is flat to up, confirming the safe haven bid is real. Silver is just more volatile. The dollar index is stronger, mechanically pressuring commodities. China is paying about $900 more per ounce for physical gold than Western benchmarks and has stopped selling investment bars. Silver is about $110 in Shanghai versus high 80s, low 90s here. Gold-silver ratio is back above 60, flashing silver is cheap versus gold again. Bank of America is openly modeling $135 to $39 silver in 2026. JP Morgan thinks a tiny uptick in global gold allocations could push gold to $8,000, with others arguing for 10, 20K over time. We are still in the middle of a 6-year silver supply deficit, and war only increases that stress. So, will silver keep crashing? It might drop more in the short term. Another crash in stocks could drag it down temporarily. But ask the bigger question. Do you believe the Eastern physical market at $110 and $6,329, or the Western paper market panicking at 87s on a war headline? My approach is simple. Use fear. Respect volatility. And when the gold-silver ratio screams silver is on sale, I add, not exit. You have to decide your own risk. But if you understand the structure, today's red candle looks less like doom and more like a clearance sticker on something the rest of the world is desperately trying to buy at full price.